That's okay. It's all good. So thank you all for joining us this afternoon to talk about research development and tax credits with our senior accountant from Kristin Ray from Lumsden McCormick. I cannot say enough about their firm and their support of the startup community in the Western New York region. We are so grateful to them for all of their support. And Kristin is no stranger to this subject matter. She's a proud Purple Eagle graduate. And even before she joined Lumsden McCormick in 2016, she was also interning with them. So she is very familiar with this space, working with all commercial entities, partnerships, S Corps and C Corps. And she knows her way around the federal, state, and local business development incentive, tax credits, Startup New York, Excelsior, New York State tax, film tax credits, which is going to be a bigger part of our lives now that we've got Buffalo Studios and Great Point Media in town. But today we're going to focus on research and development tax credits with Kristin Ray. And with that, we're going to go through her presentation, and then we'll turn camera and mics back on and entertain any questions that people may have. So with that, Kristin, thank you so much. Welcome.
Thank you, Kim. Happy to be here. Really happy to speak with everyone today and be a part of Startup Week. I think this is a great, program, a great way to really share ideas, communicate, opportunities and everything like that. So I really hope that this presentation is beneficial and that people are able to take something away from this. So as Kim mentioned, we're going to talk about research and development tax credits. Now, this is a very great way for companies, especially startup companies, to really expand your runway. It helps with cash flow. It helps increase, the dollars that you have to spend in other areas as opposed to, income taxes or something such as payroll taxes. So we will have time at the end. I cut my presentation down as much as I possibly could so I could fit it within, 30 to 40 minutes. So we'll have time for questions at the end, but just in case you want to have a conversation or send a note after the fact, here is my contact information. So a lot of things that we're going to talk about regarding R&D, what is the R&D tax credit? How is this beneficial to startup companies? What's eligible for the R&D credit? What activities are you doing that could be eligible to take advantage of this credit? We're going to look at, what costs go into effect and kind of implicate that credit and what we can take into account for calculating that credit, as well as some state R&D incentives as well. Also some things just to consider from an audit perspective, documentation best practices, and also the impact that COVID has had on the R&D credit. So first question, what is the R&D credit? So this is a federal income tax credit. I do emphasize that it's a federal credit because we'll talk a little bit later about some state credits. But generally speaking, this is going to be an income tax credit. And it is a tax credit that helps promote, research and development and innovation in the US. So it is a dollar for dollar reduction in tax liability at the federal level, assuming that you are taking this as an income tax credit. The benefit of this credit is that back in 2015, there were actually some changes to the way that the credit could help smaller businesses. So as I'm sure a lot of you know, generally speaking, a startup company is operating with losses. You don't really have taxable income. Therefore, a dollar for dollar reduction in tax isn't very helpful because you have a zero tax liability to begin with. So what this credit allows is it allows an eligible startup company, and the IRS does have a specific definition of what it considers to be a startup company. But assuming that that criteria is met, you're actually able to use this tax credit as a refundable payroll tax credit. So it can actually offset the employer portion of FICA taxes on your 941s, and anything overpaid would be refunded to you. So that's really the biggest benefit that this tax credit is going to have for startup companies, is that it can help reduce your payroll tax liability, which regardless of, whether or not you're generating taxable income or not, you're going to have that payroll tax liability that this will help reduce. When I say R&D credit, a lot of the times there are some misconceptions that come to mind. So when you hear R&D, I think a lot of people think, scientist in a lab coat in his lab doing some type of chemistry project, but really that's not what R&D is. I mean, that certainly is R&D, but there are other aspects of R&D that we can take into account that a lot of businesses are doing every single day. And that is what we can take into account for the credit, assuming that other criteria are met. Also, a lot of people, with that being said, will think that businesses only engaged in scientific or technological research are eligible. I have a nice slide that really breaks out, the different industries that are able to take advantage of this credit. And a lot of the time we're looking at, manufacturers, because they're developing new products, or they're, developing a new process to create their product, or maybe they have an existing product and they are, trying to improve that product in one way or another. So it isn't just going to be, the biological type of research that is counting for R&D. Also, like I just said, you don't have to have a significant income tax liability in order to benefit from this credit. Even startup companies that are operating with losses can utilize the credit, assuming that they meet that definition of a startup company, to offset their employer portion of FICA taxes. If the project does not move forward, it does not qualify. This also is a misconception. More often than not, it's honestly even better when your projects just don't work out, because it does prove that there was, technical uncertainty regarding that project, and it truly was R&D. We were trying something and it just didn't work out. So even if it doesn't move forward, or if it falls through, we are still able to take into account the costs up until that point when we're calculating this credit. And also, like I said before, it doesn't have to be a brand new product to qualify for R&D. It doesn't have to be something that's state of the art or has never been done before. It just has to be new to you. You have to have technical uncertainty and meet other various requirements. And assuming that that's met, it's probably something that could qualify for R&D. It could even be something as simple as, improving an existing product. So like I said, it doesn't have to be brand new. It doesn't have to be state of the art. A lot of things that you are doing probably qualify for this credit. So I think the first question, like I said, a lot of people have is, well, what industries does this credit apply to? So if you look here, and this is estimated credit amounts for credits claimed in 2020, the majority of the credits are claimed by the manufacturing industry. They're estimating about $11.1 billion in credits were claimed by manufacturers for 2020. Like I said, information technology, that is coming in at number 2 at $2.9 billion. So this doesn't just relate to those strictly like chemistry, biology type fields. It really does apply to many, many different industries. It's actually very hard to find an industry where R&D isn't occurring. I mean, it even occurs in retail industries. We'll see R&D credit claims as well. And I mean, as you can see here, mining, utilities, things that you might not necessarily think are R&D can actually qualify for that credit. So I do like this chart, and I think I mentioned this at the start of the, right before we started the program, but this really shows how the federal R&D credit has helped increase innovation in the US over the last few years. So from 2010 to 2020, we've more than doubled, the amount of research credit claims that have been filed, which I think it just, helps support that the changes that have been put into place to make this credit more usable by companies, I think is very beneficial. So we did a high level of, what is the R&D credit, high level of, different types of industries that this can apply to. I think the next question you're facing is, well, do my activities qualify for this credit? So the IRS has what is called a 4-part test. And generally speaking, if your activities meet this 4-part test, along with some other various nuances that we'll cover as well, then they're likely qualified for the R&D credit. So when we're looking at your activities, like I said, we want to break down this 4-part test. We want to document that these activities are passing what the IRS is looking at in terms of eligible R&D activities. So that first test that we have here is technological in nature. So basically what this test is looking at is, is the R&D, concerning the hard sciences, whether that be biology, chemistry, engineering. In today's day and age, computer science is considered to be a hard science. So it has to be technological in nature. It can't be based on, social sciences or anything like that. We want to make sure that it's revolving around those hard sciences. The second test that we have here is permitted purpose. So at this test, we want to make sure that, the research is being conducted for a reason, whether that be you're trying to create a brand new product. Maybe you have an existing product and you want to improve that product, even process improvement. So R&D doesn't even have to just be on your product itself. There are cases where, especially you'll see this with manufacturers, where they are trying to improve their manufacturing process to make a product quicker, make it cheaper. That process improvement is actually something that can count towards R&D as well. But basically what this second test is looking at is, do we have a purpose for this R&D? And are we trying to achieve, a new product, improved process, so on and so forth. So then that third test that the IRS is going to look at to determine if your R&D activities are qualified is there technical uncertainty, and are we trying to eliminate that technical uncertainty? So, from a high level, you can't know how to do something and call it research and development, because it wouldn't be research and development if you already know how to do it. So there has to be some form of technical uncertainty regarding, how you achieve the intended result, the materials you need to use to achieve that, end result. We're really looking at what is it that you're unsure of? What don't you know to get from point A to point B? What is it within that span that we are uncertain of? The big important thing with technical uncertainty and being able to identify that is that, generally speaking, technical uncertainty is needed, like I said, to qualify and pass this 4-part test. But once that technical uncertainty no longer exists, that generally is when also R&D ceases to exist. So you're no longer performing R&D activities once we've eliminated that technical uncertainty. Generally speaking, that's when you're going to switch over to more of commercial production. The last test that we have for this 4-part test is process of experimentation. So if you think back, scientific hypothesis, you're forming a question, you're forming a hypothesis, you're testing that hypothesis, you're analyzing your results, and then if needed, you're going back, you're reforming a new hypothesis, you're changing out variables, retesting, reanalyzing, and seeing if that gives you your intended result. Basically, what the IRS is looking for is they want to make sure that you are able to document that you have some form of a process of experimentation, because generally speaking, that process of experimentation is required to perform your basic R&D activities. And one quick thing that I do just want to note while I'm on this slide is that that third and fourth test, those are really what the IRS, at least in my experience, I've seen them hone in on the most. So they really want to see and make sure that the taxpayer can prove that there is technical uncertainty and that the taxpayer is conducting a process of experimentation. And the reason that I think they hone in on these two the most is primarily because these are the hardest to document and the hardest for a taxpayer to prove. So that's the 4-part test. Like I said, generally speaking, if we are able to pass that 4-part test, and we meet some other nuances that I'm about to mention, there's a very good chance that the R&D that you are performing is qualified for the federal credit. So just a quick note, work must be performed in the US. It is a US credit. It's meant to, promote innovation and R&D within the US. Therefore, any R&D that your company may be doing overseas would not qualify. Same thing would apply if you have contract research. So maybe they're not W-2 employees, but they are, contractors performing R&D on your behalf. If they are not in the US, then it would not qualify for the credit. Something that I do like to note here, however, is that let's say you do have a team that's overseas conducting R&D, but you have an individual that's in the US that is overseeing that work. That individual's time, as long as they are in the US physically when they are performing those activities, could be qualified for the credit. Very important, funded research does not qualify. So, what is funded research? Generally speaking, when we're looking at funded research, we want to make sure two things have been passed. So we want to make sure that the taxpayer is retaining all of the rights to the research. So we want to make sure that the taxpayer is retaining that IP. And also the taxpayer has to be at risk. So that means that the taxpayer has to be at economic risk of loss if the R&D falls through. I think the easiest way to think about this is if you have, let's say, a government contract and the government comes in and says, we'll pay you time and charges to perform this R&D on our behalf. We'll pay you regardless of if the R&D works out, so on and so forth. That's something where that will probably fall into funded research. The taxpayer isn't at risk. Depending on the agreement, you might not be retaining the rights either. So that would disqualify it from being eligible for the credit. And I think I touched on this before, so I won't spend too much time on it, but the level of technological advancement does not matter. It doesn't have to be state of the art, brand new, it could be just improvements to an existing product that you already have. Also, success is not mandatory. Failure can qualify, as I mentioned before. Sometimes it's easier to prove that it was R&D when we do have something that failed or didn't go through because it just wasn't feasible. So we looked at, industries that this applies to. We looked at, how do I identify if I have qualified activities? I think the next question that we're facing is, well, what costs go into account for this R&D credit? So the R&D credit primarily is a wage-driven credit. So what that means is the majority of the credit's going to stem from employee wages. And when we're looking at employee wages, we're looking at taxable wages. So that's going to be box 1 W-2 wages. And that's going to be for our employees that are involved in this R&D process. So when we're looking at employee time, we do have a few buckets that we can take into account when we are, calculating taxable wages for this. So I think the easiest thing to identify for taxpayers are the individuals that are working directly in that R&D process. So let's say I have a tech startup and I have 3 engineers on staff, and those 3 engineers are just all day, every day doing computer programming or software engineering, something of that nature for my new software that I'm trying to develop. Because those individuals are working directly on that project, they're considered to be performing direct R&D activities. So I think, like I said, I think that's the easiest type of time for people to identify. From there, we have 2 other buckets that we can actually pull some time in to count towards this credit. So that would be direct supervision. So let's say I have my tech startup, I have my 3 individuals that are engineers, and let's say me as the CEO, I am doing some oversight of their R&D activities. I would actually be able to pull a portion of my time. So let's say I oversee R&D activities for about 20% of my time. I could pull 20% of my wages into account for this credit. So I think this is something that's often overlooked. So people don't usually see, they don't see that time being added, which we definitely want to make sure that it's being included because it really does increase that credit. It's also very common with a startup company to be taking into account some of your higher ups as I'm sure we all know, with a startup company, it's very common for people to be wearing multiple hats. So it's very common to have, you know, a CEO, a COO, and people of that nature to have R&D time because they are performing these supervision activities. Then the third bucket that we have for employee wages would be direct support of employees performing R&D. So the easiest way to think about this one would be if, let's say I'm a manufacturer and I have a machine that's used in my R&D process. If I have a machinist that's cleaning or machining that machine, that support, that is considered support of R&D activities, and that could be taken into account as well. So like I said, there's a lot of different buckets here that we can look at for qualified wages, and a lot of different aspects that we can take into account. It's very common to, you know, not have employees that are 100% R&D, but if they have 20, 30% of their time is R&D, like I said, we can go ahead and we can include that in your R&D calculation. So in addition to wages, there are some other expenses that we can take into account as well. So we can take into account supplies used in the R&D process. This is going to be more common in a manufacturer. It's not going to be common with someone that's more in a tech or software industry, mainly because it's truly looking towards like prototypes and things of that nature. So with software, there's obviously no physical prototype. Also with supplies expense, we can't take anything into account that could be depreciated, even if it's not actually being depreciated. So an example of that would be like a computer. So if I have, back to my tech software company, if I'm purchasing computers for my employees to use in that R&D process, I would not be able to take that into account for the R&D credit because those computers, even if I'm not depreciating them, are a depreciable asset, and therefore it's disqualified from supplies expense. If you are operating in New York State, I will mention a nice little credit outside of the R&D credit that you might be able to take for that type of purchase. Next, we have contract research. So if you are unable to perform the research in-house, you know, maybe a great example, I'm a manufacturer, I developed a product in-house, however, I don't have the capability to test that product. I can contract with a third party who's going to perform that testing on my behalf. Assuming other criteria are met, I may be able to take up to 65% of those costs into account for my R&D credit. Now, something that I want to know, I did just say 65%. So generally speaking, most contract research is going to get a 35% haircut. So I could only take into account 65% of those eligible costs. The reason that is that the IRS really does want to promote, you know, having R&D activities in-house and, you know, employing people as opposed to 1099s. In parentheses here, there is, you know, 100% and 75% noted. Depending on what that contract research is for and who it's with, there could be a chance that we can take a higher percentage. But generally speaking, you are looking at 65% for contract research. The last item that we're able to take into account for R&D credits is computer leasing. So, you know, like AWS, things of that nature. This obviously, opposite supplies expense, is going to be more common in a more tech software industry as opposed to manufacturing. So here I have a nice chart. Like I said, this is a wage-driven credit. So the majority of your qualifying research expenditures will be wages, with, you know, usually contract research or supplies or AWS following after that. This is just in general. This is usually what, you know, seems normal to the IRS, but that's not to say, you know, I've had instances where supplies expense have been greater than wages. This can happen, you know, with manufacturers a lot based on how many prototypes they're producing. So this, like I said, it's not to say you can't have supplies greater than wages, but generally speaking, you're going to have wages be the higher percentage of your qualified expenses. So just a couple quick notes on, some activities that won't qualify. Obviously, anything that doesn't pass that 4-part test or, falls into the categories that I spoke about before, those would not be qualified. A few other additional things that do not qualify for the R&D credit. Research conducted after initiating commercial production. Generally speaking, once you hit commercial production, you no longer will pass that 4-part test. The reason that is because you usually, eliminated technical uncertainty by the time you go to, produce this commercially. However, in very rare circumstances, and there are some IRS court cases out on this, there could be the chance that you still have technical uncertainty, even though you've reached commercial production. So like I said, generally speaking, that's the cutoff, but there could be some very weird cases, and there are some court cases out there that support, the fact that technical uncertainty may still exist after commercial production. But generally speaking, that's our line. Research to adapt an existing product to a particular customer specifications. This generally will not be qualified. So maybe I have a product that I sell. My customer wanted me to tweak a few things for them. I do those tweaks and I sell it to the customer. That generally won't qualify. Something that I do want to note though is that could qualify, assuming that I still meet that 4-part test. Surveys and studies, so if I'm just going out and doing market research, that is not technical R&D work, therefore that's not going to qualify. As I mentioned before, when we were talking about, is it technological in nature, it has to be relying on those hard sciences as opposed to market research and things of that nature. And then also just research involving social sciences, arts, or humanities, that also will not be qualified. So we looked at, what activities qualify, what expenses can I take into account? Question is, well, what really is the benefit of this R&D credit? So generally speaking, the credit is going to be equal to about 6 to 8.5% of your qualified research expenditures. This is a very, very general statement. There are a ton of different nuances that go into the credit calculation. There's also 2 different ways to calculate the credit. So like I said, very general statement, but this just kind of gives you a general idea of what you're looking at in terms of what the dollar value benefit may be. If you're taking this as an income tax credit, unused credits, if I'm not using the credit in the current year to offset a tax liability, that credit can be carried back 1 year and it can be carried forward for 20 years. Something that I want to note here, because I've seen this a lot with startup companies that I have worked with. You may not expect to have taxable income for, maybe you aren't expecting to have income for 2 more years, and then in 2023, let's say you think that you will finally have taxable income. You might be thinking to yourself, well, I've had losses all of these years, so those net operating losses should be able to offset the taxable income that I'm expecting to have in 2023. Something that I want to note is that, actually 2 quick things I want to note. The first would be, so when the Tax Cuts and Jobs Act occurred, it passed in 2017, it changed the way NOLs can offset taxable income in a current year. So the Tax Cuts and Jobs Act made it so that net operating losses could only offset 80% of your taxable income. Then with COVID, the CARES Act came through. The CARES Act reversed that for a couple of years and said, hey, we're going to put the NOL rule back to 100%. So if you're falling into a tax year where that CARES Act is applicable, that NOL can offset 100% of taxable income. However, once that is up, the following year, it's going to be back to 80%. So you're going to switch back to NOLs that can only offset 80% of income. So your NOLs, depending on the year they were generated, will either offset 80% of taxable income or 100% of taxable income. So there is a chance that you might not have enough 100% NOLs to offset your taxable income, and you may be limited to offsetting only 80% of that taxable income. So this tax credit is a nice way for you to help bridge the gap between, you know, what the NOL is able to offset and any tax that's due. Another thing that's very common with startup companies, and why, you know, I always advise to rethink this payroll or rethink the income tax credit, is it's called a Section 382 limitation. So when you are going through your series, let's say you have a seed round or a Series A or a Series B, those fundraising rounds are changing your ownership. So if you reach a certain percentage of ownership change, it triggers what's called this Section 382 limitation. And from a very high level, what happens is that essentially limits your NOLs and some of your tax attributes, and makes it so that they're either extremely limited or in some cases they can't be used at all. So once again, it's just something to plant the seed, something to think about. You might not have as many NOLs available as you may think, and the R&D credit is a really great way to help bridge that gap. As I mentioned before too, if you're an eligible startup company, this R&D credit can help offset the employer portion of FICA taxes. Generally speaking, if you're eligible for the payroll tax credit, we say go ahead and take it because this is an immediate cash benefit, assuming that you do have payroll and employees on payroll. And then something just to note as well, obviously as a C Corp is a tax-paying entity, so that entity would be able to utilize the R&D credit if it was an income tax credit. If you have an entity that's taxed as either an S Corp or a partnership, because those are flow-through entities, the tax credit would flow through to the owners. So one quick thing that I want to know on software development, just because I think this is very common, especially in, you know, that more tech industry, is internally used software versus non-internally used software. So the IRS has a very narrow definition of what they consider internal use software. The IRS considers internal use software to be software that's used in your general and administrative functions. Anything that is not used in your general and administrative functions will generally be classified as non-internal use software. And the reason that identifying the difference between the two is important is that internal use software must pass an additional test in addition to that 4-part test and all of that other criteria that we talked about. In order for the internal use software to pass those tests, it must be innovative, it must involve significant economic risk, and it may not be commercially available. And something just also to quickly note on software development, anything related to aesthetics, purely aesthetics, will not qualify. As we mentioned, you know, we really want to focus on the technical aspects and those hard sciences. So something that I want to note here as well, there are some proposed changes to R&D expenses in the way they are treated for tax purposes. So like I said, Tax Cuts and Jobs Act was passed, and what it did was it changed the way we can expense our R&D costs. So anyone that's filed tax returns has probably been expensing the R&D as it's incurred. The way the current regulations are, you know, we're allowed to do that. We don't have to capitalize R&D, we can expense it as incurred. Starting in 2022, as it currently stands, businesses will no longer be able to expense R&D costs as incurred. Those costs would have to be amortized over 5 years if the R&D is conducted in the US, or 15 years if that research is outside of the US. So the reason I think that this is important, and I've definitely been, you know, advising my clients on this, and I definitely wanted to share it, is because if a client or a taxpayer has significant R&D activities, you know, if we can no longer take that expense in the current year as it's been incurred and we have to capitalize it, that could swing taxable income. And if those expenses, you know, if your current expenses excluding R&D and the amortization of R&D don't totally offset the income that may have been earned in the year, you could have taxable income when you weren't expecting to have it. So that's why I just wanted to note this. I don't know how many people have been paying attention to the news in terms of tax law changes. There is a proposal to postpone this. I believe the last time I checked, and it changes every day, but the last time I checked, they were trying to push this back until 2025. So something to keep an eye out for. I'm definitely keeping my eye on it and advising clients accordingly. So real quick, just some quick things to consider when you are claiming an R&D credit. Generally speaking, claiming a tax credit does increase the audit risk of the return. That's really why, and I'm going to stress this in the next few slides, contemporaneous documentation truly is key when claiming an R&D credit. If you're claiming an R&D credit on an amended return, that increase or that risk of audit increases. But I mean, and we advise our clients on this as well, making sure that you have that contemporaneous documentation and that we are, documenting that that 4-part test is met, that all of those other criteria are met. We're clearly identifying how we're calculating credit, the costs that are going into that, all of that, making sure that we have that all documented really helps if the credit were to be audited. So I never want someone to feel like, I shouldn't claim this credit because I might be audited. Like I said, it isn't necessarily a bad thing as long as you have your documentation in place to support the fact that you are eligible and that you've calculated the credit correctly. When we're looking at employee time, it's very often, especially with startup companies, you might not have a process in place to track that time. So we highly recommend, and I'll talk about this on the next slide, developing some type of time tracking process, because the IRS does target the use of estimates. If you're estimating that 20% of this person's time is taken into account for R&D, how are you justifying that 20%? What do you have to support that 20%? That's what the IRS is going to ask. The IRS does rely on employee testimony. However, that is adding an added risk for your company. The IRS has a statute of limitations where they can go back and they can audit a return. So there is a good chance that that employee that maybe headed up your R&D in 2021, there's a good chance they might not be with you 2 years down the road, and they may not be willing to cooperate and go through and help you with this audit. So that's why, contemporaneous documentation truly is key. And we work closely with our clients as well to make sure that we're implementing best practices and, we're really helping to make sure that we dot our I's and cross our T's on this. So as I mentioned, documentation best practices. We have a handout that we've developed internally that I provide to all of our, R&D clients here. It breaks it down into, how do I document my R&D activities in general? And then how do I document, all of the different expenses that I'm taking into account for this credit? So the first box is, how are we documenting our R&D activities? I think I've stressed this. I've said it at least 5 times, but I'm going to say it again. Contemporaneous documentation is key. Test reports, emails, patents, meeting minutes, things going back and forth. If you have a team working on an R&D project and they're sending emails back and forth to each other, having that documentation is great. Also, something that we recommend is, keeping a list of your qualified projects throughout the year as you're working on them, with the name of the project, description of what that project is, and then also documenting how that project passes the 4-part test. We have a spreadsheet that we use here at Lumsden to really help our clients document their projects and how they pass those tests. In terms of wages, making sure you have everyone's job title. You're including documentation or a note on how that individual was involved in R&D. Maybe, you noted the project or projects that they worked on throughout the year. And also like a time tracking system really helps in terms of wage tracking. For supplies and computer leasing, once again, documenting how that supply or that AWS was used in the R&D process. If you are qualifying some supplies but not others, keeping some form of write-up of why something's qualified and why something isn't. Especially when we have like supplies expense in AWS, maybe create a separate general ledger code that you can code that supplies to. Maybe if you're a manufacturer, you're coding everything to just cost of sales right now. But if we can break out cost of sales from R&D supplies, that can really help. Not only does it make it cleaner and easier to track that R&D supplies, it also helps from the study standpoint in terms of knowing, you know, where our R&D supplies is. And then the last, contract research. So always make sure you have a copy of that contract. I think I touched on this briefly, but there are some things that contract research has to meet in order to be eligible. If the credit is audited, the IRS will definitely be looking at those contracts. We also review the contracts to make sure, you know, you are retaining the rights, you know, you're at risk and things of that nature. Also just documenting how that contract research is related to your R&D activities. And I know under each of these subsections, documenting how that expense is related to your R&D activities is mentioned. And the reason that is that the IRS really emphasizes that they want to see the nexus between your R&D activities and the expenses that we're qualifying. So we need to essentially be able to show the IRS, these are our R&D activities that pass the 4-part test. This is how these R&D activities relate to these expenses that we are now qualifying for our credit. So as I briefly mentioned, this was all based on the federal R&D tax credit. States also have R&D credits. I believe most states, I want to say maybe 36 or so, do have state credits. So that's something to look at as well. You know, if you have a majority of your employees based in California, maybe we take a California R&D credit on top of that federal R&D credit. It truly is going to be based on, you know, where your R&D activities are being performed. So as I mentioned, just a couple of cool R&D incentives that New York State has outside of an actual R&D credit. So if you saw on that map previously, New York State does not have its own standalone R&D credit. However, there are some other incentives that the state has for taxpayers that are involved in R&D. The first that we have here is the R&D investment tax credit. So this is a tax credit that can be taken on fixed asset purchases that are used in the R&D process. So a great example would be if I'm a tech startup and I bought all of my employees new computers, I may be able to take the investment tax credit on those computers. And it's great because if you are a new business, and I believe the New York State defines a new business as, you know, you're in your first 5 years of operating in New York State, that actually becomes a refundable credit. So even if I don't have a tax liability, because I'm a startup, I have losses, if I have zero tax liability, that tax credit then is refunded to me and becomes cash in my pocket. So that's really where a tax credit like this is very beneficial. Also, there is a New York State sales tax exemption on machinery used in the R&D process. And also, I don't know if anyone's familiar with Startup New York, there's also a program called Excelsior Jobs Program. It is also an employment incentive credit. If you're in the Excelsior Jobs Program, there is an R&D component to it as well. And you could take up to 50% of the federal R&D credit as a refundable New York State credit. And once again, refundable credits are great because even if I have no tax liability, my tax liability is zero, this credit is refunded to me and becomes cash in my pocket. So just real quick, R&D study process, this is kind of what our process looks like. We have a phase 1, and that's just going to entail an initial conference call with Lumsden and any third parties if necessary. This we do at no cost. Primarily, we're trying to help you determine if there are R&D activities in your business, and if so, is there enough to make it make sense to pursue a study? So we do more of like a cost benefit analysis. And like I said, we do that at no cost. Phase 2 of our studies, on-site visits, if necessary, we'll do interviews with key personnel. So, your engineers, anyone that's directly involved in the R&D process. We just want to kind of talk to them, get a better understanding of, your R&D activities during the year, the people that were involved in those R&D study or in those R&D activities, the costs that are going into account, things like that. Then we perform, our calculation of your qualified research expenses, what that credit would be, and then we collect any contemporaneous documentation that you're able to provide to us. And then our third phase here, documentation and report, we just issue a nice report that honestly, it almost serves as your first line of defense if the credit is audited. It essentially breaks out our calculation, shows the wages, the employees that are going into account for that credit, as well as, any supplies or computer leasing or contract research as well. Something I just want to quickly note, we're just about to the end of my presentation, then I can open it up for questions. Is just, there's been a lot of credits that have come out due to COVID, the biggest being the employee retention credit. So there is some interplay between some of these credits and the R&D tax credit, mainly because we can't double dip. So if we're claiming wages for the employee retention credit, we can't claim those same exact wages for purposes of the employee retention credit. So it's something to note. The employee retention credit generally is going to be more beneficial than the R&D credit. However, there are ways to maximize both. Here at Lumsden, we have the R&D team that I'm a part of. We also have a team that specializes in employee retention credits, and we work very closely together when we have clients that are, claiming both the employee retention credit and the R&D credit to make sure that we are maximizing both credits for our clients. So like I said, just something to note because I know that that credit is very common. It is a great credit to take advantage of, but also there are ways to make sure that we are maximizing all credits. So key takeaways before we get to questions. I know I talked about a lot here, but really, if you're going to take anything away from this presentation, knowing that the federal R&D tax credit can provide an income tax credit. If it's not used in the current year, you can carry it back 1 year or carry forward for 20 years. If you meet the definition of an eligible startup company, we might be able to actually put cash in your pocket through the refundable payroll tax credit to offset those the employer portion of FICA taxes. And also, your company is probably already conducting these qualified activities. So it's just a matter of, us helping you identify those activities and then performing a study and getting that calculation together. So that's all I had. Any questions?
Kristin, I can't rave enough. Comprehensive, understandable, and if companies aren't taking advantage of it, shame on them.
Thank you. Yeah. Like I said, a lot of companies, I think there's a lot of misconceptions. Like when you think R&D, you might think someone's in a lab, doing a chemistry experiment, but really a lot of our companies are performing R&D, especially startup companies. Generally speaking, in that startup phase, that's when you're trying to figure out, how to bring your idea to life. So this really is a great way, assuming that, we meet that payroll tax requirements to be able to put cash in pockets through this.
With regards to the documentation, I know startups, they get so overwhelmed with all of the elements of the business. They're trying to launch it, they're trying to track things, and sometimes you don't know what you don't know until it's too late. Are there super simple, easy things like Quicken or Microsoft Project that have built-in tracking for payroll and hours? Is a simple spreadsheet in Excel good enough?
Yeah. So what I've seen in practice a lot, because I think you hit the nail on the head. There's what the IRS wants to see, but then there's also applying that to real life. And how do we make this feasible and doable, especially for a startup company where you're probably wearing 5 different hats in one day. So yeah, I mean, in practice, I've seen, especially on the tech side of things, a lot of companies will use, some type of software that's tracking their software development projects. So that's something that can be very common. On the other end of the spectrum, I have seen, taxpayers use spreadsheets to keep track of employee time on projects, especially if you only have like a few projects in a tax year. It's probably very easy to use more of that spreadsheet tracking aspect because you don't have as many things that you're tracking. And then as you continue to grow, maybe you do look at a software that can help track internal projects. Something that we've done internally is we've developed a spreadsheet for our clients that we recommend that they fill out throughout the year as they're working on these projects so that they can document and keep track of eligible projects, a brief description of those projects, and then also documenting how those projects pass that 4-part test. Because really that's what the IRS is going to want to see and what they're going to want to know.
That's perfect. Thank you all. So appreciate all the information, Kristin. Thank you again to our sponsor, Lumsden McCormick, for sharing this bright young talent with all of us. And I think this is one of those videos that's going to live on in infamy because we're going to share it. It'll have great shelf life. And years from now, you'll have people be walking down the street and go, "Oh, I listened to your webinar. You have no idea how much money you saved me."
Hey, I'm more than happy to help. So if anyone has any questions too, by all means, my contact information is here on the presentation. So please feel free to reach out.
That's great. Thank you, Kristin. Thank you all.
Yeah,
and
thank you.
Have a fabulous rest of your day.
You too. Take care.